Today we're going to talk about an income stream that can grow faster than inflation. I'm talking about the dividend on the S&P 500. We're going to take a look at the SPY ETF, which is the S&P 500 dividend over the last 25 years, and compare the growth of that dividend to U.S. core inflation over the last 25 years. I think you'll be surprised by the results. Look, when it comes to protecting and preserving your wealth, especially in retirement, inflation is your number one enemy. You always want to be growing at a rate greater than inflation. Not just your principal, but also your income stream. It's very important that both your principal and your income stream are growing more than inflation. Not all investments will do this. I have some other videos on TLT ETF, for example, where you can clearly see that some investments fall way behind inflation. So it's really important, especially as you enter retirement, that you do have investments in your portfolio that can provide you inflation protection. So let's dive into it. Let's start with this beautiful graph of the S&P 500 dividend over the last 125 years. The S&P 500 dividend has compounded at 5% for over a century. This is powerful stuff. And with only a few exceptions, 2008, for example, or back in 1929, has the dividend come down. And in all cases, it's recovered. It took about 4 years to recover the dividend when it went down about 25% in 2008. But the dividend graph, as you'll notice, is much more consistent and much smoother than the S&P 500 price, which can move all over the place and can suffer from long periods of no return. The dividend is much more reliable than price appreciation on the S&P 500. For this analysis, we're going to assume that a retiree had invested $100,000 of their portfolio in the S&P 500 using the SPY ETF on January 1 of the year 2000. We're also going to assume that they've spent the dividend every year for the last 25 years. Where would they be today? And how has the dividend grown? And how is that growth compared to inflation? That's what we're going to look at. So here we are in the year 2000 making our $100,000 investment in this retiree's portfolio. And all these years later, that principal amount, the $100,000, has grown to $406,000. A lot of inflation protection there on the principal. I would point out, however, what I was saying earlier, the price of the S&P 500 cannot be relied upon. You need a long time in the market to get these kind of returns on your principal. Notice that from 2000 to roughly 2013, there was no return on the price of the S&P 500. Plenty of volatility there. The S&P 500 dividend has been much more consistent and reliable than the price of the S&P 500. We're looking at the last 25 years of the S&P 500 dividend, and what jumps out is that period of 2000 to 2013, where the S&P 500 had no return on price, you made money on the dividend between 2000 and 2013. The dividend was going up during a period of 2 recessions and a lot of volatility for the S&P 500 price. Here is the actual dividend income stream that our retiree received for their $100,000 investment in the S&P 500, SPY, back in the year 2000. The first dividend was $1,025, first annual dividend. By the year 2023, the annual dividend had grown to $4,516. Excellent growth of the income stream and plenty of inflation protection. Since the year 2000, U.S. core inflation has averaged 2.38%. Now that doesn't sound like a lot. And when you look at the graph, you can see that inflation has been fairly benign most of that time, only jumping up recently and then coming back down. But when you add up all these years of 1.5% to 2.5% inflation, we get to a pretty substantial raise in core prices. core prices are now up roughly 80% since the year 2000. This table shows how inflation has affected our retirees' income stream. The first annual dividend that our retiree received was $1,025 back in the year 2000. So we're growing that number by inflation every single year, core inflation. And by the year 2023, we would need $1,786 annually to purchase the same amount of goods that cost us $1,025 back in the year 2000. Fortunately for our retiree, the growth of their income stream, the SPY dividend, has been much greater than the growth of inflation. The initial $1,025 dividend that our retiree was receiving is now $4,516 by 2023. That's a 341% top line increase. Even after we adjust for inflation, if we take the $1,786 inflation adjusted value of the initial dividend, and we take the difference between that number and the 2023 actual dividend of $4,516, this retiree is still up 153% after inflation. That's the real growth of their income stream. It's impressive. Now that we've established that the S&P 500 dividend can give us plenty of inflation protection over the long run, let's take a look at what happens with the principal. What kind of inflation protection can we expect from our principal that is invested in the S&P 500? We would need approximately $180,000 in late 2024 to purchase the same amount of goods that would cost us $100,000 in the year 2000. $100,000 was our principal investment in the SPY ETF. So today, we want to see the value of our initial investment be at least $180,000 and preferably a lot more to give us some protection from inflation. Since our initial investment of $100,000 has grown to over $400,000 by late 2024, our principal has also grown faster than inflation. Our top line growth on our principal, 307%. The after inflation adjusted number, 125% growth of our principal. Interesting to me that the growth of the principal is not as strong as the growth of the dividend when adjusting for inflation. So let's add it all up. The S&P 500 dividend has grown at a rate greater than inflation over the last 25 years. And in addition to that, the S&P 500 price, your principal in the investment, has also grown at a rate greater than inflation. It's powerful stuff. Also, it's a very important concept for retirees. You need to stay ahead of inflation. If you are retired or getting ready to retire and you're watching this video, I would encourage you to watch my other video on TLT ETF, No Match for Inflation. And in that video, you will see what happens when you have investments that cannot keep up with inflation. They will degrade the value of both your income and your wealth over time. So you don't want to be too heavy on ultra-conservative or conservative investments that cannot keep up with inflation. I hope this video was helpful. I hope it gets you thinking, helps you better analyze your investments, and overall improve your family's financial plan.